Welcome back to The Explainer. All right, last time we got our feet wet with the basics of options. Today, we're diving into the deep end. We are getting into the world of complex, multi-leg strategies, and we're using the incredible book 151 Trading Strategies to guide us.
So I want you to forget about simple bets on whether a stock is going to go up or down. Today, we are all about the engineering side of trading. We're going to learn how to construct these intricate financial machines, each with a very specific risk and payoff profile designed to do one particular job.
Okay, so let's get into it. The first step in building any machine is understanding its basic parts, right? In the world of options, this means learning how we can replicate one financial instrument by combining others. We call this a synthetic position. And the blueprint, the absolute foundation for this entire field of financial engineering, is a core principle called Put-Call Parity. Now, this isn't just a theory, it's a fundamental mathematical relationship. It basically says that a specific combo of options can perfectly mimic other assets. It's the law of gravity for the options world.
And here's exactly how we put that principle to work. Just like it says in section 2.10 of the book, we can build the financial equivalent of a long forward contract, which is basically a promise to buy a stock later without ever touching the actual stock. You just buy a call and sell a put, both right at the current market price. And the result? It's a position whose final payoff acts exactly like a forward contract on that stock. You've literally engineered a stock position out of pure options. This is our first and most crucial building block.
Okay, so what happens when the price of your engineered synthetic stock gets a little out of sync with the price of the real stock? Well, that creates this beautiful, logical opportunity for something we call arbitrage, a risk-free profit that exists only because of a temporary mathematical glitch.
This table just lays out the logic perfectly. A trade called a conversion is pure arbitrage in action. If the synthetic stock is trading for more than the real stock, you just buy the real, cheaper one and sell the synthetic, more expensive one. That price difference, it becomes your locked-in, risk-free profit. You're basically a market mechanic, finding a loose bolt and tightening it.
All right, now that we have our building blocks, let's construct something totally different. Let's engineer some machines that couldn't care less about which direction the market goes. Instead, these are machines designed to profit from the magnitude of a price move, from the sheer chaos of it all. You know, these are pure volatility plays. They're just perfect for situations like a big earnings announcement or some major news event. You are certain a stock is going to make a huge move, but you have absolutely no idea if it's going to be up or down. Your outlook is neutral on direction, but you are very, very bullish on movement itself.
The long strangle, which is detailed in section 2.23, is one of these volatility engines. And it's so simple to build. You just buy two options, an out-of-the-money call and an out-of-the-money put. That's it. You've basically placed a bet on both sides of the market.
And the math here is it's beautiful. Let's break it down. Your final payoff, F sub t, all depends on where the stock price, S sub t, ends up. If that stock price flies way above your call strike, K1, or dives way below your put strike, K2, you make money. Of course, you have to subtract the initial cost, T. But simply put, you profit from a big move, either way.
Now, the strangle has a cousin called the straddle, and the key difference is the straddle uses at-the-money options. The big trade-off for the volatility engineer is right here on the screen. A strangle is cheaper to build because you're buying those cheaper, out-of-the-money options, but it requires a much bigger price explosion to actually become profitable. Okay, so we've built a machine for chaos. Now, let's engineer the complete opposite. A sophisticated machine that is designed to profit when the market goes absolutely nowhere. A machine that literally profits from stability and stillness.
And this is the butterfly, straight out of section 240. Just look at this elegant construction. You buy two calls, the wings, one in the money and one out of the money. This defines your profit range. Then you help pay for it by selling two at-the-money calls, and that forms the body. You are essentially getting paid to bet that the stock will stay pinned to a very, very specific price.
And the payoff formula here just reveals the whole secret. The combination of those long and short positions creates a profit profile that peaks perfectly right at that middle strike price, K-mid. The further the stock price moves away from that center point by expiration in either direction, the more your profit just melts away until it turns into a small, defined loss.
And what if you want to give the stock a little more room to breathe? Well, you can build a condor. As described in section 2.46, a condor is basically a butterfly with a wider body.
You just separate those two short call options you sold, and that creates a plateau of maximum profit instead of a single peak. It's a slight tweak to the machine for a different tolerance.
So here's where it gets really fun. The crucial point is that we can keep combining these core ideas, almost like Legos, to create these highly specialized structures. We can engineer trades for very specific goals, like maybe dramatically reducing or even totally eliminating the upfront cost of a trade.
Let's take a look at the exotic-sounding Seagull Spread from Section 2.54. It's really just a brilliant piece of financial engineering. You start by building a standard directional bet, in this case, a bull-call spread. But then, to pay for it, you sell an option on the opposite side of the market, an out-of-the-money put.
The whole goal here is to carefully pick your strikes so that the money you get from selling that put completely covers the cost of your bull-call spread. If you can pull that off, you've created a zero-cost structure. It's a free bet that the market will move higher. But, and this is a big but, it comes with the new risk of that short put you sold.
And for our final construction, we have maybe the pinnacle of this kind of financial machinery, the box spread. Now, this isn't a bet on the market at all. It is a pure arbitrage play that is, by its very design, almost completely risk-free. It's built by combining a bullish call spread with a bearish put spread.
Now, I want you to look very, very closely at the payoff information you see on this slide from Section 2.52. Do you see what's missing? The stock price, S sub T. It's completely gone from the final equation.
The final value of this position has absolutely nothing to do with where the stock price ends up. The market's movement becomes completely irrelevant. The profit is a known mathematical certainty the second you place the trade. It's a machine designed not to bet on a stock, but to exploit tiny mispricings in the options themselves, which are often related to interest rates.
And the quote on this slide perfectly illustrates the catch. Because these are pure mathematical profits, they don't last long. The book is very clear that these opportunities are the domain of sophisticated quants and high-frequency trading algorithms that can spot them and execute on them in microseconds.
Which leaves us with a really fascinating final thought for this explainer. If it is truly possible to construct these complex machines to engineer what is essentially risk-free mathematical profit, what does that tell us about the nature of risk itself in financial markets? Is risk just a temporary bug in the system that arbitrage is constantly trying to fix? Something to think about.